Capitalism right now is going through a reckoning. There has to be a way in which profits and planet align. ESG, in theory, should help, but that's not what is happening today.
Our sustainable investments benefit you and parts of the world that need it most.
The whole business is built on the idea that you can invest in companies that will allow you to do well as an investor, but also can do some good for the world.
Perhaps the greatest investment opportunity in modern history.
ESG is now big business. It represents, by some estimations, something like $35 trillion worth of investments. And in the last 2 years, it's grown by 15%, and that rate of growth doesn't seem to be stopping.
Underneath this entire system are ratings that look a lot like the credit ratings of companies, but are based on completely unregulated data. And one company has come to completely dominate that business, and that's MSCI.
So even though a lot of people are talking about ESG, not many know what goes into making an ESG rating, for example. And that rating is what becomes the basis for decision-making for investors.
ESG ratings focuses in on what's significant to a company's bottom line.
What we found is that the foundation of this multi-trillion-dollar new cash machine for Wall Street is not at all what it appears to be, and that it's really almost exactly the opposite of what people think it is. I'm Cam Simpson. I'm a senior editor and reporter for investigations at Businessweek and Bloomberg. There are about 160 different companies that sell data and ratings that purport to rate companies on their environmental, social, and governance practices or factors. Because it's a completely unregulated business, because it's completely subjective, the ratings can land anywhere across the board. MSCI's rating system is built on scores, and they're converted into ratings that look like credit ratings. AAA, top of the line, CCC, bottom. By mimicking a credit rating, which is regulated, which is based on regulated data, MSCI has created kind of an aura of respectability, an aura of confidence for the investing world around these ratings.
I'm Akshat Rathi, and I'm a reporter with Bloomberg News. I write about all things climate. MSCI has been around for more than 2 decades, and it started its life as a company that would arrange stocks in an electronic index. As the company progressed, it found this demand for ESG metrics, that people were interested in not just ensuring that they were making profits from their portfolios, but that the companies within those portfolios were also aligning with society's goals. And so about 15 years ago, MSCI acquired a number of companies that gave it the ability to be able to create ESG ratings. MSCI has become the giant in the field. By one estimate, 40 cents on every dollar that is spent on ESG ratings is earned by MSCI. So what MSCI does with its ratings really matters to the entire industry.
So if you're a company, especially a bigger company that's included in the S&P 500, for example, your ESG rating can really significantly help you in the world to get included in one of these funds. It can lower your cost of capital, which also can help you. And so they're really keen to have good ratings. And so when a company's rating goes up, MSCI produces an updated report that shows what the key factors were that led to the company moving up the ESG ratings ladder, moving up its score, moving up its rating. And so I started just with that, with a list of companies and upgrades, and to see how quickly and how high some of them could climb. We found half of the companies out of the 155 that we looked at got upgraded just for sitting still, because MSCI changed the way it weighted the score or changed the methodology, so their scores went up as a result.
Take McDonald's, for example. Its total emissions are those that match the entire country of Portugal or Hungary. And much of those emissions come from its use of beef. But when MSCI gave it an ESG rating upgrade in April 2021, it did that by reducing the weighting of emissions from a mere 5% to nothing, and instead replacing it with a new initiative that McDonald's had launched around recycling. Except that the recycling initiative came from installing bins in select locations in the UK and France. And when we looked at that, we found that within UK and France, there was either an upcoming regulation or a threat of a regulation which would have forced fast food companies like McDonald's and others to anyway install these recycling bins. And so McDonald's essentially got a ratings upgrade for doing the bare minimum that it should have done anyway, and for not being counted for all the emissions it was putting out into the atmosphere. And McDonald's is not a singular example. It's actually quite typical. When we looked at the 150 upgrades, nearly half of the companies got that upgrade in their ESG rating without even fully disclosing their emissions.
We found the factors that were driving upgrades over and over again were for things like what MSCI calls corporate behavior. The other one that also was kind of surprising was data protection, and also the structure of boards deemed to be a factor in potentially having better outcomes for shareholders. Of the 155 rating upgrades that we looked at, we found only one where a reduction in carbon emissions was cited as a significant factor in the upgrade. The rating system and the ratings themselves create exactly the opposite of what many investors believe they're looking at. When they see a highly rated company, they think that company has strong environmental, social, and governance practices in terms of its impact on the world, its sustainability. But what they're actually measuring is exactly the opposite. Is the company sustainable? Is the value to shareholders sustainable? What's the impact of the world, climate change, water shortages, potentially on the company? It was a hard thing to get our heads around until we saw it all together in the data.
MSCI is the leading provider of investment tools in the world. And as such, our basic raw material are sophisticated models, big data, and advanced technology.
Henry Fernandez is the CEO and chairman of MSCI and has been since the founding of the company. And we met Henry at COP26, where governments meet, but increasingly businesses have been playing a role in shaping the conversation around climate change and how much they are doing to help fight climate change.
We asked him, do you think ordinary investors, retail investors, have any idea that the entire lens of the system is the impact of the world on the company and not the impact of the company on the world? And he said no, that they didn't have any idea. And in fact, he said he thought even investment managers who are putting together these funds didn't grasp it. They're not really concerned about the impact on the world, the investment managers. They're fiduciaries, and their interest is in their fees.
He said he's a libertarian and that he would like as little government intervention as possible, and wanted to ensure that the use of ESG would be one way in which he can stop any socialist ideas from creeping into capitalism at any cost.
This is a permanent change in the way capitalism works. And by the way, we're doing this to protect capitalism. Otherwise, government intervention is going to come, socialist ideas are going to come, and the like. So it's not against capitalism. It's about, dealing with the externalities that are created in capitalism.
Henry Fernandez was born into an incredibly privileged family in Latin America. Henry wound up at Stanford, where he decided to get an MBA. That was really kind of at the height of the greed is good movement on Wall Street. And Henry then decided that he would go into finance. He ultimately found himself at Morgan Stanley, and Morgan Stanley had a partnership with a company called the Capital Group International. By the start of 2019, it was clear that this massive shift, driven significantly by millennials and their pension funds, was really going to take hold. And that created demand for investment managers all over the world to sell investments to the public that purported to make the world a better place. So Henry Fernandez took his bland kind of back office Wall Street company and he rebranded it, and he's done pretty well from it since.
Your company has had an amazing run since it was spun off from Morgan Stanley. What'd you say, up 10 times since
Maybe
2008?
More than that. We went public at $18 a share 12 years ago, and it's $220 today.
Henry appears to be the first ESG investing billionaire. His shares are now worth about $1.3 billion, which makes him almost as wealthy as Tim Cook, the CEO of Apple.
Companies have a hard time, oftentimes, getting their founders, getting their directors, getting their executives to invest in their businesses. Henry has his whole net worth in his business. And basically, his board actually said to him, "We'd like you to sell a little bit of stock, Henry." And Henry said, "I'm not going to sell stock. I think I'm going to make 3 or 4 times my money in the next 10 years.
Absolutely.
Why should I sell any stock? What am I going to
ESG ratings have come under the scanner in recent years. And so in this wild west of ESG ratings, regulators now are honing in on figuring out a way in which they can standardize how ESG ratings are made and make sure that ESG ratings don't end up greenwashing a company's activities.
The Securities and Exchange Commission has come up with a regulatory agenda to bring in more regulation as far as ESG disclosures are concerned.
It'll be critical, I think, in the next several months to see what the Securities and Exchange Commission does and whether or not they're going to crack down on some of the claims that are really critical to bolstering ESG investing versus what ESG investing really is.
Society hasn't changed. You would have been intolerant of a transgression 100 years ago, except that you didn't know it. It was not prevalent. Now, today, you can find out very quickly if somebody is doing something wrong, and therefore society's tolerance towards that is very limited.
There's no question that shareholder action can move companies away from things that are really, really driving climate change or other ills in the world. But those moments are incredibly rare. And the idea that investing in these funds is doing anything to make the world better, it's really, really hard to see how that's the case. And there is a huge demand from people, especially young people around the world, to not have their pensions and their investments destroy the planet that they live on. Whether it'll be met with anything that's real is a really hard to answer question.